welcome to today's short webinar on all things to do with finance, particularly with agency finance and how it impacts upon your own personal finances. If you don't know me, as I say, I'm Stephen Knight, and we'll be talking today with Geoff Day. And really the session is about your own personal finances and your objectives for financial security for you and your family. Obviously, markets are in turmoil at the moment, driven by changes principally across the pond, with obviously a new man in the seat. We've got war and uncertainty in the world. And at times it can be pretty hard to try and figure out really what you should be doing with your money and how to protect it. Whilst I guess we all kind of crave for a return to the norm, I suspect there's no such thing as normal anymore. And coping with high tax, low growth, and the ever-changing political and economic environment is something we all have to get used to. The winners from last year's autumn budget have been the accountants, the tax advisors, and to be honest, people like Geoff, as advice and insight has become even more important than it was perhaps previously. Geoff and his business, Wilcox Day, you can find them on the Pimento portal, have been members of Pimento for 4 years, and they've been giving support, ideas, and practical advice to our members. He's also been helping our younger members through Club 30 learn to manage their finances, something that's sadly not taught at schools. Returning and running his own successful business in the past, he's also worked in corporate life. He's a qualified financial independent advisor, and along with his team, he specialises in helping agency owners to develop a plan, their business objectives, both personally and financially, and help map out a future. He's worked in the UK, despite his accent, for 25 years, and he's run large corporate teams operating within global firms, and he's now running his own financial advisory business, and he's regulated by the Financial Conduct Authority. Okay, so Geoff, welcome. Thank you for joining us. We've got 26 minutes to basically enlighten everyone with some insight, I hope, from what's happened recently, in particular, obviously, looking at last autumn's budget. Can I start with one that's really beginning to bite as we move into April next month, obviously, start of the new financial year? Can you just talk me through, obviously, with the implications of the national insurance and national minimum wage changes? How do you see those impacting on our businesses in terms of costs? What's the likely impact we'll have?
Absolutely. Two quick things, Stephen. I've got to say that's probably the most professional you've ever introduced me ever, so I'll take that. And second of all, he highlighted the accent. It's Canadian, just so if anybody's curious. Now we're going to be part of the 51st state, so I'm not sure what passport I'll have in a year's time if things continue the way they go. So, but I clarify those points straight out of the gates. But yeah, the budget that came through, it's being cynical. They backed themselves into a corner when they said they weren't going to increase NI and they weren't going to increase income tax. And what they then did is they put all the burden on employers. And as a consequence of that, it is meaning that our costs are going up. It means our clients' costs are going up. And as a consequence, that's going to put pressure on budgets, which when you look at the normal bellwether for sort of the economy, often marketing, recruitment, and those sorts of things are good indications of where things are going. You're going to find, I think we're going to see a lot more cost pressure there from employers, and therefore everybody's going to be trying to negotiate value in deals. Couple that with what's going on globally with Donald Trump and trade tariffs and uncertainty is people are kind of being a bit more mindful of what do we hold from a cash perspective. So I think the trading environment's going to get a little bit tougher, which probably doesn't come as a massive surprise to many people. Questions around inflation are really brewing around right now because everything from the employer's national insurance change to the tariffs are inflationary. And as a consequence, we could see interest rates go up. But as we're starting to tilt further forward towards a recessionary type environment, and we were moving, would we get a soft landing for a recession perspective, you might see that actually causes interest rates to drop. So everybody's guessing right now on, are things like tariffs going to be enough that it causes a recession and then interest rates come down? Or are they going to be enough that they push up the inflation that we try and curb spending again, like we did back in 2022 and 23? And we could see things where there's more pressure on borrowers with interest rates. So it's not a real positive picture. Economically, there's still a lot of legs in the market, but it's geopolitically what will drive it. And I've got to be careful because this is recorded. What we are hearing on a day-by-day basis changes on a day-by-day basis the next day when he announces something, and then people realize the implications. So when he threw trade tariffs on everything coming out of Canada, and next thing you know, all the auto manufacturers showed up in Washington going, most of our parts come from Canada. We actually will not be able to produce a car. He eased off. So every day things are going to change, and we're going to see a real fluidity there.
I mean, one wonders the kind of the U-turns on some of the things he's been announcing, whether eventually people will then basically no longer worry too much about his latest announcement in the understanding that actually within 24 hours it's going to be reversed or will be watered down.
And it will be. And, let's be clear, we saw him in Trump 1.0, where we saw trade wars. And the financial markets dropped by like 18% during that year. But by the end of the year, they pretty much recovered. This will be a negotiation tact, a bit of an agent of chaos to create instability, to try and create opportunities, like the Ukraine-Russia deal that he is potentially going to sign very soon, which is him getting really cheap assets out of Ukraine, whilst he's putting on tariffs to the rest of the world. So he's negotiating, and he's going to basically use the collective might of the US to get the deal he wants. And if he doesn't get it, then he'll just decide I'll back out of that because it's not going the way I want. It's outstanding to watch.
Yeah.
It's terrible to try and guess.
I mean, but I guess behind the question is the reality is that you can't do anything about this. You can only control what you can control. And
Yep.
therefore, you have to look at your own personal situation and that of your agencies. And there are things that are within your power and things that you can do that will actually put you both personally and professionally in a much stronger position. One of those things which you mentioned, I think, on a previous call was the concept of salary sacrifice pensions, which is something I hadn't heard of. Can you talk me through what that is and how that can be a positive?
Yeah, absolutely. Funny enough, I've had two calls in the last 24 hours from employers going, how do I deal with this employer NI cost? And we're looking at salary sacrifice pension. So you as an employer, let's say you've got 25 employees, you have an obligation to put people into a pension. It's under auto enrollment rules. If you're not doing that, oh my God, please do, because there are some teeth with that. When you put them in a pension, they make a contribution and so do you. The beauty of salary sacrifice is the employee agrees to give up some of their salary in advance for that pension contribution. And that means that that's going to save you employer's national insurance at 15% of whatever the contribution is. And it's also going to save the employee national insurance. So the exact example of a client, and it makes me laugh because they approached me 2 years ago and they've got 60 employees, central London firm, doing really, really well in the agency space. And we ended up, they wanted to review their pension. I said, don't bother. Your employees don't really care right now. Spend your money on other things. Day after the budget, I dropped them a line and said, now's the time to review your pension because although their cost base is going up by £85,000, we think on the employer's NI savings, we're going to be able to save them about 20 to 25 grand a year. And because all we're doing is we're redirecting the employer pension contributions to be taken before they're ever considered taxable. And as a result, they save the entirety of employers' national insurance on those contributions. And if we can educate employees to enjoy and engage with the pension more, the more they pay, the less the more the employer is saving an employer's national insurance by having this mechanism in place.
Does
Quick rule of
does
thumb.
that? Sorry,
I was just going to say,
Carol.
quick rule of thumb. If you've got over 25 employees and an average salary of 25 grand, just really finger in the air, absolutely have to look at this. If you've only got 5 employees and a low average income, for example, you're not going to get that economy of scale that comes through to justify the cost of transitioning to a new pension provider, for example.
Okay, so you actually have to move to a new pension provider. You can't stay with your existing pension provider.
You can stay with your existing pension provider, but if you do, everybody needs to sign up to move to salary sacrifice. If you
Okay, so
change the
as a
pension
whole,
provider, you can do it
yeah,
on the auto enrollment rules and everybody automatically goes in. It's like what they do with donor cards now. In the
yeah.
past, as a donor card, you had to sign up for it. Immediately when they said, oh, we're just going to opt everybody into donor cards, everybody is now donating their kidneys when they die. Beforehand,
Okay.
not many people did.
I had no idea about the donor card either. God, you live
Yeah.
and you learn. So,
Yeah.
on the salary sacrifice thing in general, are there other things that you can basically put into that tax?
Yeah. There's other things like if you've got enough employees, you can look at salary sacrifice cars. If you've got things like you can do cycle to work schemes. So there's lots of salary sacrifices. It's been around for ages. There's some ways you can give some voluntary benefits that help people save money. some of it comes down to a bit of critical mass. So if you've got enough employees, the more you've got, the more you can save, and therefore it'll justify the expense and cost of putting it in. Whereas if you're not going to have the critical mass, you've got to question, is it worth the financial cost at the time that you're looking at how do you rationalize your own expenditure? Guy I just talked today, we worked out it's going to cost them about 8 to 9 grand in year one to set up a brand new pension for 90 employees and put it in place. We figure they're going to save 28 grand a year in employers' NI going forward. So realistically, in the first 6 months, they've had the payback mechanism. It becomes a no-brainer. It's more of that administratively, how do we get it in place? Project takes about 3 to 6 months to get in and do it right. But communication is key, which should be music to the ears of everybody on this call in the marketing space.
Okay, yeah. Internal communications is not necessarily always the forte of agency life,
No.
but I understand the point. So the key actions there are speak to your accountants,
Yeah.
understand basically what the opportunity is for you and how much your
Yeah.
employees can actually save. And then if you need to make a move to a new pension provider, then obviously seek out who's in the market and where
Yeah.
to go.
Yeah, a quick
But
ready reckoner is look at your pension contributions, for example, and say if my employees are paying, I will make up a number, 50 grand, knock 15% off if you move to salary sacrifice, and that'll give you an idea of the savings.
okay, brilliant. Are there anything else in the budget that owners of agencies might have actually missed or not be aware of?
Yeah, this is a big one, and I can't believe it's not more on the radar. So lots of people heard about IHT on farms, and I disagree with it fundamentally, but that's
IHT,
just on a
can
personal
you
view.
just explain what IHT
Sorry,
is, please?
inheritance tax. So beforehand, if you died and you owned a farm, your farm went to your loved ones free of any inheritance tax. Now, after £1 million, there's an inheritance tax liability, and that is at 20%. Now, they've introduced, so in the past, Stephen and I are in business together. We've got a business worth £5 million. Great. Historically, if I died, my wife inherits my half, and that's free of inheritance tax because it was classed as business relief. Going forward, Stephen and I own a business for £5 million. My share is 2.5. If I was to die, then actually the first 1 million goes to my wife tax free. The next 1.5 million would be taxed at 20%. So suddenly my wife has a £300,000 inheritance tax bill she never had before. Now I can tell you right now, if I hadn't made provisions for my family in the event of my death, she'd be coming and knocking on Stephen's door going, I'm not losing my home for the sake of this business. I want 300 grand now. And if Stephen's lost me as a business owner, he might be going, I can't I can't raise funds. Geoff delivered a lot of our sales revenue or he did something else. And so suddenly you're going to have businesses that might lose a key person within that organization or shareholder. Unexpectedly, they could be saddled with a large inheritance tax bill. And there's going to be a really disruptive nature in that business, which I shouldn't call my wife that. But if she's now going, well, I'm not going to leave my family home for the sake of this business. Stephen, if you can't buy me, I'm going to sell you to my share to anybody that'll buy it. And she might sell it for less than the 2.5 million. She might go out and have it as a business partner that Stephen has that he never wanted to work with. They might sell half of the business to a competitor because she wants to stay in the home. So this is, I don't know how it's not been more in the press of the implications of this, but if you've ever had a business value and it's significant, you have to look at, do you have shareholder agreements in place? Do you have protection against these sorts of things? Because if there's an unexpected event, not only is your business at risk, but actually there could be quite sizable inheritance tax implications and some problems. And it's not been anywhere. I just don't get it. And accountants are talking about it. It's weird.
If you have a shareholders agreement where your shares would go to the other shareholders who aren't necessarily your spouse in this situation, is there still an IHT issue for them?
Uh, There is because it was still an ownership piece. So what you would then do is we have what's called a shareholder agreement in place where you should set up a shareholder agreement and you put insurances in. So again, exact same scenario. My business is worth 1.5 million. We have a shareholder agreement. We have insurances in place. I die tomorrow. Stephen gets a 1.5 million pound insurance payout. That legally goes straight to my wife. Stephen now owns 100% of the business. And as a
Okay, so these are
consequence, then It's clean.
And these are the so-called key person insurance policies.
Yeah, that's a shareholder agreement, but key person is another one that you can put in place. Which every business, if you've got multiple owners, need, and we don't do shareholder agreements, by the way. This isn't selling my services. We'll do the insurances and cross options, but every business owner, if you've got multiple partners within your business, you should have a shareholder agreement. Because at the moment, if one of you dies tomorrow, for example, what's going to happen to their shareholding? In the absence of documentation, it could be sold to a competitor. It could be kept. You might not have a right to buy it out. And now, Stephen, you might have my wife getting half of the revenue, but adding no value to the business. And you're now having to run twice as hard for not as much money. And
Right.
so having a shareholder agreement is really, really critical because you've set the ground rules for how this business is going to be dealt with. And then you start to work through of how do we then protect the business and how do we get ourselves in the right place. And go out and get business valuations. If you don't know what your business is worth, how are you going to know you're okay later on?
Yeah, I mean, we just take it that things will be the way they are, and I
Yeah.
hope for the best. And very few businesses within, certainly in the agency world, I mean, it's not as common as it needs to be that people have shareholder agreements in place. I hope most of the people on today's call do. The other thing you mentioned when we were talking was basically the idea of offshoring the UK and starting to think a little bit different about actually where we sell our marketing services and thinking a little bit about actually, don't, we traditionally, a lot of the agencies on today's call have been very UK focused. They might be working with international clients, they might be
Yeah.
working with US entities, etc. But they think of themselves as a creative agency that's fundamentally, or an agency fundamentally servicing UK-based business. Tell me a little bit about the whole issue around both foreign exchange and the changes there, and equally to what we should be doing as agencies to try and broaden our outlook.
Yeah. I always look at when there's change, where's opportunity? Now, again, at the moment, coming back to Trump and tariffs, it's predominantly on goods. It's not so much on services. Now, if we look back the way the GBP has capitulated versus the pound or versus US dollars. So actually, as a result, we're cheap. And I'm laughing when we look at a firm I do some work with, a global consultancy firm. They've identified that when they were selling in US resources, they're now actually able to meet their margins by selling in UK resources because when you add in the currency exchange, UK resources are cheap right now. So actually, why not go after the US market and say, well, hold on, you can get great creatives, you can create great marketing expertise. You don't have a language barrier, so you don't have to ship it out to India, for example. You can get all the skill set that we've got and actually quite a big discount based on currency exchange. I was talking to somebody that does buys and sells for agencies land, and I said, well, why aren't you going around to all of your American contacts and saying, well, why don't you just buy in the UK? It's going to be 20 to 30% cheaper than it was previously just based on currency exchange. You've got no language barriers. You get access to a bit of Europe, which bizarrely, all of these trade tariffs might give the UK more opportunity to transact with Europe again as well. And so, is there an opportunity as a result of what's going on economically right now to say, well, actually, can you expand your market and do it at a good price point? Especially if when you see what's happened with the US wages and everything else that have gone up quite significantly, actually, does it open up new markets that you haven't really tried to tap into before?
Yeah.
And one of my guys, they run a completely different, it's all about data, data management, building data warehouses and everything else. They haven't had a UK client in the last 2 years. Every client they've got is US based because they're going in and basically getting it at 20% discount compared to US based consultancies. So go big and go home or go home because actually
Yeah.
the UK market's going to get quieter potentially, given what's going on, as I said at the start of the call, but has your market opportunity expanded? Rolling
Okay,
into
so
that,
yeah, sorry, can I jump in there? So two outtakes from me there are, we are probably 20% cheaper than our US counterparts.
yeah,
And most importantly, their budgets are 10 times the size because of their population.
yeah,
So you got it, you got two winning combinations there. And of course,
yeah,
the other one is the Middle East and Dubai in particular. And a number
yeah,
of Pimento agencies have set up offices there in the last
yeah.
2 years. I was speaking to a new member that's just joined us yesterday, and they're about to launch their office in Dubai. So everyone is beginning to recognize that, don't just look at your local opportunity, look overseas.
And rolling on from that, what you have to be very mindful as you do it is how you manage your currency exchange. So we do work with a currency broker who's brilliant. They essentially, if you go through your bank and you try and do a currency exchange, they take a much greater margin. You can put in this third party service where essentially they just go, great, you're getting paid in US, they receive it in US dollars. You choose when you want to convert it into GBP. And actually, the margins that they're taking are wafer thin compared to anybody else. So if you want to have a chat to me, drop me a line if you're doing any overseas work. And I've seen huge value from both my individual clients and my corporate clients that are looking at how they save the money on that.
Okay. Right, let's move on from there, we may, and talk a little bit about scenario, which I think is a lot of people are beginning to think about at the moment in terms of, if one does get bought by an American organization, or for that matter, anyone else, how does one begin to actually look at how you can actually benefit your pensions and your profit extraction? What should one be doing at this particular moment in time? I mean, given that most businesses today, and I say most businesses, most small businesses essentially utilize their pension allowance in order to be able to actually extract profit from their business in a tax efficient way and to lock it into a pension, which is also supposed to be tax efficient up to this point. Clearly, you have to have profits in the first place to be able to extract the money. But talk to me a little about the changes in that space.
So let's talk just on a pension piece, and I'll give you a couple of numbers here of kind of why they're still beautiful. I actually do have a shirt that has a heart on it and says "I love pensions" because I actually do. When you look at the tax efficiency, they're brilliant. But then I assume we're going to leapfrog into the idea of exit planning because this plays a big part of that later on as well. The numbers, let's do it at a high level. If you had a really good profitable business and you put 40 grand into a pension, and it's this employer payment, that's the equivalent of salary sacrifice because you're not paying any employer's NI or employees' NI. That £40,000 that you put in saves 25% corporation tax. So right away, your business is paying £10,000 less in corporation tax. Not just that, if you are a dividend payer and a higher rate dividend taxpayer, you get that money without paying 33.75% dividend tax. So you've got 40 grand out of your company saving 58.75% in tax. There is nowhere else you can possibly make that money work and sweat that hard. Simple as. The bit you want to do is not take oxygen out of your business because if it goes in a pension, you can't take it out the next day. So if you've got a business where you've been stacking up cash, you need to start thinking about, well, how do I extract profit? Putting in a lockbox for me later on when I'm no longer running my business and I'm no longer working. Because those numbers, if you're going to put in 40 grand and save 58.75% in tax, it's costing like 15 grand to turn it into 40. And all you do is just put it in the bucket, wait till later until you're no longer working, and then say, now I've got this beautiful war chest for my lifestyle. I don't care what you've used on our pensions, there is nowhere else you can be that efficient. But it's a bit like when you're not on an airplane and they come on and the cabin decompresses and the oxygen mask comes out, it says, put on your oxygen mask before you put on anybody else's. I see pension funding for a business, the same thing. Make sure your business has the cash flow, make sure you've got the stability and structure in place. But then anything above that, then start slapping the oxygen mask on and putting out your pension and your future self. Because actually it's just woefully tax efficient. And most people don't realize just how so.
And
So it's still attractive.
it's still attractive, but your business has a particularly tough year, and let's be honest, last year wasn't a stellar year for a lot of agencies. They may not be in a position to be able to lump cash into their pension. Just a reminder, how many years can you go back and how much can you put in?
Yeah, so I've just done carry forward for a client where we're putting 200 grand in. So you can essentially look at it, you can do 3 years back the way. Most people don't have £200,000 in cash they can just throw in. This lady, she's got a business that's got 500 grand of profit this year. We're going to put £200,000 in and save 25% corporation tax. She's old enough that the next day she can literally take all that 25% back out and put against her mortgage. So she's basically saved all the corporation tax to wash it through.
And
But
basically takes out her mortgage at the same time.
exactly, but take out what you can afford. So you can
Okay.
do regular payments and then you can just accelerate as you come to either the tax year end or your company year end with single payments if you've got the cash flow. Just don't ever extend yourself.
Okay. So in terms of tax planning for an exit, what's the sort of timescale? I mean,
Yeah.
obviously a lot of M&A specialists, and we have a few of them within Pimento. We work closely with a few, and I've got an interest in one myself. So we talk about developing the relationships with the agencies 2 or 3 years out before they even consider exiting in order to maximize the value of that business and help them through that process. But very often the taxable element of it, that conversation really only happens in the last 6 months. When
Yeah.
when they've got offers on the table, they then start to think about actually what's the best way to do this deal, and what's the implications for myself personally and for the business.
Yeah. So the simple bit is the earlier you start this journey, the better. And the reason why is we've all got allowances. So you can put 60 grand a year into a pension. You can put 20 grand into an ISA. You've got limits as to what you can do. And so I had a guy that sold a business for 2.5 million. He was introduced by his accountant and said, "What do I do?" And I said, "Well, speak to me 6 years ago, because now we've got a limit that there's only so much we can do about putting money into multiple products." And that means we've limited his efficiency later on and how he can access funds because we didn't start early. The earlier you start, the more flexibility it gives us to use all of the tax rules available to us. And I'm conscious on time, so I'm going to basically give an analogy that I did in a presentation to 150 business owners in November. This happens regularly with business owners that I come across, is they come to us very late in the day, and they're entirely reliant on an exit for the future they want. Now, using a slightly different analogy is if you went to go and skydive and you walked into the airplane and they gave you only a single parachute with no reserve, would you go up in the airplane and jump out? Probably not. Most people would want a reserve chute in case something goes wrong. As a business owner, if you're not planning for your future and you're entirely reliant on a future exit, it's like jumping out of an airplane with only one parachute. So what if you wanted to exit next year and we go into a recession and it's a global recession? Well, you're going to lose 30 to 50% of your sale value because actually the market isn't going to be there for acquisitions. So it's like trying to jump out of a parachute or out of a plane with a single parachute. The more we can take weight off of that single event by building up a reserve of having a pension, by reducing your mortgage, by saving into ISAs, that then when you go to sale, you're not just reliant on that one single thing. And it's the biggest advice I can give to any owner is if you just rely on a single event, you have a problem. And I've got this with a recruitment agency right now. Recruitment markets really slowed down. And I'm like, we didn't start this early enough. You're going to have to push out your retirement 3 to 4 years to get back to a good EBITDA to be able to sell again because you haven't done enough to get in a good place. And so
Okay,
the
well, on
more
that
you can do, the better
rather
off.
depressing note,
No,
having
just take
to
control. It's
push
better.
push out the next 3 or 4 years. There's a lot of resources that have been put in the chat box. What we'll do is we'll share that with everyone afterwards, insights and all sorts of things that one can look at. Listen, this is a massive, massive topic. We've only given it half an hour. We'll probably do another one of these in the future. Thank you very much indeed for the points that you made this morning. Obviously, a lot to talk about and think about. But the key outtakes for me are there is some good news in the budget for businesses. You can do something to actually improve your own personal outcome and the outcome for the business itself. So do take the opportunity to speak to your accountants or your IFAs, and don't just kind of bury your head in the sand because that's not really going to help anyone. Final thing, we've got 3 events coming up next week or so. We've got the 5 p.m. Club on the 13th. That's on Thursday. That's tomorrow. We've got the Club 30, the Secretive Club 30 for those people who are lucky enough to be under the age of 30. It's on the 19th. More details there from Spencer. And our next get together in London this time with Ruben is on the 27th of March. All those details you can find on the Pimento portal. If you're a guest today, you're not a member already, drop me a line and I can see whether I can help you and get you along. Super. Thanks again. Have a cracking day, everyone. And hopefully you'll find some ways to actually save some money and save your agency some money. Cheers. Bye-bye.